obviously. So I think we're at the kind of the main event of this chat is kind of going over your, the model for the earnings per share we're projecting, and Matt, it's really your model you put together. And are you able to share your screen and kind of go over it here? Or
yeah, let me know. Can you see the model up now? All right, great. So I can't see you for some reason now, so I'll just walk through. Let me know if it's not showing up on the screen. All right, good. So yeah, this is the model. I've got the 4 most recent quarters with actual results in here in these columns. Q3 is my projection. So we'll kind of walk through some of the major changes quarter over quarter from Q2 and kind of what they mean. So I've updated this with the actual deliveries from the production and delivery report that we got over the weekend. So one of the big changes from Q3 to Q2 is just that you've got a significant amount of Model S being delivered this quarter. Those are obviously high margin vehicles, so that will, I think, go a long way toward improving the overall automotive gross margin. So not only do you have higher gross margins on those, but I think in Q3 or in Q2 you probably had some negative pressure because you were not amortizing some of the cost of the equipment over vehicles in Q2. So that should be a fairly decent boost. And then you've got I think a similar thing happening with the Model 3 and Y, where you've just got more output from the same factories. I mean, this is all obviously coming out of Fremont and Shanghai. So you've just got 33,000 more vehicles being produced, and all the overhead costs of the facilities and the depreciation expense. Some of it is depreciated on a per unit basis, but some of it is also depreciated over time. So no matter how you really cut it, you're going to have better margins just based on the fact that you've got more output coming from the same capital deployed. So that's certainly good news. One thing I think maybe a lot of people are not thinking about is the full self-driving take rate. So this is something that I estimate based on a lot of the releases that Tesla's had historically. We know that their take rate in China is very low. In Europe, it's low, but not quite as low in China as it is in China. And so I've been able to kind of piece together that this has been falling over the last several years. So in Q2, I estimated it was 18% on a global basis. I'm projecting a pretty significant drop in Q3 to 13%. And the real reason for that is sure, you've got more units being shipped to Europe and China, which we know has a lower take rate. But I think the other thing which will impact take rate in the US is that you've got a subscription option now. So I do think there's going to be fewer people buying the purchase option outright. But to kind of make up for that, I've got this subscription option coming here. So I'm assuming 35,000 people will subscribe to FSD in Q3. So a relatively small percent. I mean, it's roughly 10% of the new deliveries. I don't know, that's not right. What is it? Math's a little mental math. Yeah, somewhere around there. Yeah, 15%. But it's not necessarily only new deliveries. You have to also keep in mind that existing vehicle owners who just didn't buy FSD could also subscribe. So this is going to be a relatively small impact. You can see here, like subscriptions in Q3, I'm only expecting $20 million of revenue. But over time, this is just going to continue to accumulate. And so I think if you fast forward 3, 4, 5 years, where you'll have just quarter after quarter of more people subscribing, I think it's eventually going to be a very big deal. But in the short term, it actually, I think, probably hurts Tesla's financials that they have this as an option. Let me finish walking through the model, and then I'll walk through a couple of charts that I have. Okay. We can let's sorry, collect my thoughts here. The FSD cash intake is actually decreasing a little bit sequentially. So if you think of the 18% take rate that I had in Q2 on a smaller base of units, that generated $490 million of cash coming into Tesla. Again, this is a bit of an estimate, and that's decreasing to $461 million in Q3, and that's just due to the lower take rate. This is not all recognized immediately, as we all know. So you got this, 42% that I've estimated that is actually deferred until probably in Q4 most of that will be recognized. So there's going to be, $1.6 billion. That's my estimate of the current deferred revenue balance. So that's going to hit Tesla's financials, I think, sometime over the next, 12 months, but probably a big chunk of it in Q4. The amount that's in Europe and in China, that may take longer. But still, it's a huge amount, and it will flow through the financials and have a benefit at some point. But about half of the, so you got $268 million of GAAP earnings benefit this quarter, which again is down sequentially. I'm assuming $400 million of credits. That's kind of a middle of the road estimate in my mind. And then I've got a couple other smaller items here: acceleration boost and FSD subscriptions. So putting this all together, I'm at $13.8 billion of total revenue. I just grew the energy revenue by about 15% and the services revenue by the same. I might be high or low on those, but the margin is relatively small, so it probably won't move the needle too much. Then the big thing that I wanted to kind of talk about is the manufacturing margin that we talk about. So this is the what I call the core manufacturing gross margin. So how profitable are Tesla's core manufacturing facilities? So excluding full self-driving and any credit sales, how profitable is just the core operations? Bradford Ferguson has done a lot of work on this, kind of talking about quarter over quarter, what are all the benefits, like we mentioned, the Model S and the shift in Model Y production. Martin Viecha has talked about the Model Ys being exported to Europe from China being the most profitable vehicles. So that's going to be a boost. And I've tried to kind of piece all this together. I think optimistically, there's maybe like $1 billion of gross margin upside quarter over quarter, but I don't think it's necessarily going to be quite that high. So, we were at 2.9 last quarter. I'm at 3.75 this quarter. So there's a little bit of wiggle room potentially on the high end, but I also, I don't want to take credit for everything. I want kind of my estimate of a middle of the road gross margin that I think Tesla can achieve. So that's kind of what I've gone for here.
Yeah, 31.8% there, gross margin. That's pretty impressive.
So that would be the first time Tesla's had a gross margin that high. And I mean, honestly, if I were to go back, 2-3 years ago, I don't think anybody would have ever thought Tesla would achieve this level of profitability, let alone so soon. So people talk about Tesla's valuation being crazy, given the fact that they only sold 500,000 cars this year. But they're not only experiencing, over 50%, year over year growth, at least this year. But they have incredibly profitable, just kind of core operations. So they've really, we all know they have this minimalist design philosophy. They're deleting all sorts of parts that they don't think are necessary. And now that they're manufacturing at scale, you're seeing a lot of the benefits of that philosophy kind of flow through the financials. So it's impressive. I don't think they'll go back below 30% for the foreseeable future. Even in an environment where I'm expecting 5%, cost or price declines every year. And even with that, I do think that they're going to be able to kind of maintain these margins.
Yeah, and just to interrupt you for a second, I mean, that 30% gross margin plus number, which I think is very likely as well. 31.8% we're projecting this quarter. Maybe it's a little higher next quarter, or maybe it's the same or even lower as other factories come online. But 30% plus on average over the next several quarters as volume increases, that's super impressive. And, my natural mindset is to think, oh man, the stock's going to take off like crazy. And maybe if the stock hadn't gone up 20x in the last 2 years, that'd be definitely the case. But yeah, I mean, I'm just trying to put water on the fire of my excitement that, the stock has increased 20 times in the last 2 years already in terms of market cap. And, it's hard to know how much of this kind of growth and margins is built into that market cap right now. If the stock had been only gone up like 3x in the last 2 years, I'd say, oh yeah, this is, then it'd be much more likely it's going to go up another 3x or whatever, But it's just, it's hard to say because of the super big run up that it had already and 800 billion market cap it has right now. but it's very exciting. I'm excited. I'm a long-term investor, and I still think by the end of the decade, it'll be the biggest company in the world. But, just as the next few quarters are going to be monstrous, I'm just throwing water on my excitement here. That the stock might not go up to 2,000 or 1,500, like I think a lot of people probably feel emotionally it will.
So I do somewhat agree with you. It's interesting though, because I was going back through my initial thesis from 2019 on what I predicted the stock was going to 2 to 4x at the end of but over the next 12, or basically over the course of 2020, because I made this model based kind of prediction in just like December of 2019. But my thesis there was that the FSD take rate was going to go up, and that you were going to have that be 100% recognizable basically by this point in time. And instead, what we've seen is that FSD take rate has decreased steadily over time, but Tesla's just core manufacturing efficiency has been way, way, way better than anyone expected. So from my point of view, I kind of agree with you that I don't know what the stock's going to do. But in the back of my mind, I have this initial thesis that I had is still intact, that, FSD take rate can go from, let's call it 15% today to, 30, 35, 40% overall in the coming years. And if they do that on top of like a ridiculous just core manufacturing efficiency, I mean, it's not unthinkable to think that you could have, 40+% automotive gross margins. And so, in a scenario like that, there's just the numbers start to look silly, and so I do think there would have to be some sort of re-rating. But I like to follow the facts, and right now the facts are pointing to a declining FSD take rate. It's going to take time for that to turn around, and so that's why I'm very keen to kind of see how FSD progresses.
It's a good point.
So, going on to energy and services, there was frankly a surprising uptick in Q2. I'll just go over to the chart for this one because it probably makes it easier to see. So energy gross margin had been, right around zero historically. In Q1, it was really low. It was negative 11%. Q2, it rebounded drastically to 2.1%. So that kind of tells me that they really turned the corner in being able to monetize gross margins, probably on solar roof in particular, but also on their stationary storage deployments, which did increase a lot in Q2. So I've assumed a modest, increase from 2.1% to 6% in Q3, and then essentially keeping services margin roughly the same at negative 2%. I tend to think they'll always run services at break even, but they do have a benefit of used car prices are continuing to be resilient overall, and for Teslas in particular. So I think that'll help a bit on that front. Anyway, kind of putting all that together, we get back to some overhead costs, which I have increasing sequentially. Stock-based compensation increasing again. This does include Elon's compensation package, but there's a lot of stock-based compensation for the rest of the employees as well. So even though he may have, I think, peaked in the amount of his SBC that is recognized in each quarter, I think that's going to decline from here. But the rest of the employees still do have that stock-based compensation. So I don't think the overall number is going to drop. Anyway, putting all that together, one other point to highlight: in Q2, there was a really low effective tax rate that Tesla saw. It was only 8.9%, I believe. So I've normalized that out to 25% in Q3. But putting that together, I'm at $1.83 in non-GAAP EPS. Last time I checked, the street average was around $1.40, somewhere in that neighborhood, $1.43 maybe it was. So there's a pretty big disconnect, I think, between where I am based on all the things that I'm putting together, and I think where the Wall Street analysts were. Those estimates, I'm sure, will continue to come up in the coming days and weeks, just as analysts rerun their models with the actual delivery figures. But in my mind, I mean, talking about Tesla's valuation, one thing I like to try to do is look at like the annualized PE ratio. So if you were to take this $1.83, multiply that by 4 quarters. Sorry, I can't see this now. So this will get you to like an annualized earnings rate. So then you take today's price, what is it, 780, and divide it by that annualized earnings per share. You're only at 107 on a PE. So to me, that's provides a relatively stable, level of support that if Tesla continues to execute in the way that they are, I think that's going to make it harder for the stock to fall back to say like 500 or 600, something in that range.
Yeah, if it went down to like 5, if it went to like 400, it'd have like a 50 PE pretty much, next quarter, because the earnings will probably be $2 next quarter or something. So
exactly
50. And then, it would just look kind of ridiculously cheap for such a fast growing stock. So I agree. There's a nice backstop for how low the stock can probably go as these earnings are increasing. That's good.
Yep. So just run through a couple of these charts quickly, because I think we've already touched on most of this, but you can just see how this deferred revenue balance has increased, sequentially quarter over quarter. And if you just think of the fact that they're, only recognizing roughly half of the FSD revenue that they have right now, then every quarter in the future, not only will you have some amount of this recognition of deferred revenue, but you'll also have about $200 million, maybe more, of recognition on full self-driving that in the past would have been deferred. So that's a benefit that's going to be there that I think a lot of analysts are not actually modeling out properly. Then this is my estimate of that core manufacturing, how that gross margin, how that has increased over time. I think your point is right that, as Berlin and Austin come online this quarter probably, but over the coming quarters, that's probably going to apply a little bit of pressure to the gross margin. So going forward, I would expect that to drop a little bit and then kind of recover as those plants get up to scale. And then you can see here, I think, we already touched on these for energy and services. So